stop at everyone that has your stop loss here. You trick traders into thinking that there's a breakout. Both sides of the equation are losers, unless in this video, I'm going to be teaching you how to first identify consolidating markets. Number two, how not to get wrecked on consolidating markets. And number three, how there is actually a golden opportunity inside consolidating markets that allows you to take really high probability and really high win rate trades if you know what you're doing, which you will after you watch this video. And by the way, if you don't know who I am, my name is Xuan. I'm on a mission to make the world's best trading education suite by making trading easy for everyone. And without any further ado, let's jump right into the video. Now, just to start off on ground zero, I'm going to first teach you how to identify consolidating markets, because sometimes there can be a bit of confusion regarding what is considered a consolidation. And also, for the purpose of this video moving forward, I'm going to stop using the word consolidations. I'm going to start using the word ranges. Ranges and consolidation is the same thing, right? So you don't have to worry. If you ever hear traders talk about ranges, just understand that they're talking about consolidations. And here's the thing that you need to understand about ranges before we move forward, is that at every given moment, the market is always in some kind of a range. It doesn't matter what time frame you're looking at. It doesn't matter what chart you're looking at. At every given point, the market is always in some kind of range. Now, just to paint this picture for you, that is a swing high and that's a swing low. So you can say that, technically speaking, that price is currently trading between these two levels at the moment, where you might expect that if the price were to come back down to the range low, you might expect it to go back to the range high and to form what is known as a consolidation. So this is the current trading range that price is in. But also, at the same time, if you zoom out a little bit, you can also say that, price is also trading within this range high here and this range low here, where the majority of the price action at the moment is focused between these two levels. So if you were ever to come back to the range high, you would be going down to the range low. So this is not to be confused with the traditional term of consolidation. Now, even though ranges and consolidations are mostly the same thing, consolidations in particular, right? One way that you can truly identify a consolidation is when price no longer continues to make highly volatile movements. So notice how that during this phase in the market here, the price was moving pretty aggressively and it was going straight up. So this is called a trending market. And obviously the opposite of a trending market would be a consolidation. So you can see that for the past about 2 weeks, close to 3 weeks at this point, that render on the daily chart has been in a consolidation. Now, at this point, you might be wondering, like, hey, how do I actually identify consolidations, right? How do I know if a consolidation is coming? Well, the way to do this is also very simple. Number one, there are usually two ways that we use to identify this. One is a higher time frame key level has been taken out. So this is the first way to identify if a consolidation is likely to happen. And then number two is if news event is over. So these are the main two ways that you can identify. Now, before I do talk about, either one of these events, I need you to first understand a principle that underlies every single financial market and underlies every single move. The market is always oscillating between phases of high volatility and low volatility, meaning that after every high volatility phase, you will get low volatility, which is, consolidations. And after every, low volatility period, you will return back into a high volatility period. Either it pumps or it dumps. And this is really important to understand, because I'm sure you guys have heard, other traders talk about this before, about how, Bitcoin has been consolidating for the past, 4 months or something. And so the move coming out of that consolidation is going to be very explosive. And that generally is true. The longer the consolidation, the more explosive the movement tends to be. And that has to do with the fact that the longer you stay in a consolidating period, the more liquidity that you build up on both sides. I want you to imagine for a moment that if you were some kind of retail trader, I'm just going to go onto the 4-hourly so that this looks much more like, a traditional consolidating market. I want you to imagine for a moment that you are a complete beginner to the markets. All you know about trading is that there's support and there's resistance. And usually beginners tend to get taught that, the more times, quote unquote, resistance gets tested, or the more times support gets tested, the weaker they're going to be. And if you do go long, let's say here in the middle, you're probably going to be placing your stop loss, underneath this quote unquote support. And if you're going to go short at any point in the middle here, you're probably going to be placing your stop loss above this quote unquote resistance. This is how the average Joe is going to be thinking when they see some kind of consolidating markets. They mostly tend to get in the middle before identifying like what is the higher time frame trend. Like they have no idea which direction the market's going. They just sort of see some green candles and, they're in, or they see some down candles and, they're shorting right in the middle. They don't have any clear sort of TP or stop loss strategy. Like they just get chopped up in the middle here. So that's like scenario number one, which is very common. If that sounds like you, after you watch this video, you're probably never going to make that same mistake again. In fact, you will learn how to take advantage of these dumb traders, or as what I like to call them, dumb money. Take advantage of the dumb decisions that they're doing and actually profit off of them. And that's scenario number two. If price were to head into, any of these levels, let's say I'm going to go short once, quote unquote, resistance get tested, or I'm going to go long if support gets tested. So that's scenario number two. And scenario number three is once a price breaks above quote unquote resistance, you're going to treat this as a breakout and you're going to go long. And essentially you're going to be placing some orders here, as price is breaking out. And all three scenarios are really important to understand because all three scenarios add up to the fact that there is a lot of orders being placed above, the swing highs and a lot of orders being concentrated below the swing lows. In fact, if you were to pull up a traditional heat map, you'll be able to see that there's a large concentration of orders above and below range. And this just basically goes back to illustrate what I taught you before, that the longer the market stays in a consolidation, the more liquidity gets built up on both sides. And again, and this is also really important to understand, and this mechanism, like once you understand how this works, this opens up a new, level of possibility that you can have in your trading. For example, you understand that most of the people that are going to be, getting stopped out here, the fact that you understand that there's a lot of liquidity, above this level means that when this level does get taken out, you can take advantage of this and actually go short on the liquidity sweep, right? This is called a liquidity sweep. And this word alone here is the reason why ranges can be so profitable. In fact, I love trading ranges. I love when the market is in a consolidating period because look at how many times the price just comes to the swing low, sweeps the liquidity and just goes to the opposite end of the spectrum, right? You see liquidity here, once gets swept, second time, third time, and then just goes all the way up here, stop out everybody that's placing their stop loss above this area, right? Notice how the market moves just a little bit above the previous level to really make sure that they stop everyone out. And every single trader here that's been getting into the breakout is going to be in for a really rough time because the market just dumps on the very next candle. And all of this is lining up with a news event. Now, as of the time that I'm recording this, it's Friday. And 2 days ago, there was a news event on NVIDIA where they were releasing their quarterly earnings. And it's basically one of the most anticipated news events in all of crypto. And the reason I say all of crypto is because of this coin right here called Render. This coin, use case of this coin is that they provide it has something to do with GPUs and rendering, which is exactly what NVIDIA is doing. And render is also related to AI. And the reason why this is relevant is because NVIDIA is, they're basically the market leader when it comes to AI processors. They own about an 80% share in AI processors. So this was the day where their quarterly earnings was coming out. And general consensus of the event is that if the quarterly earnings are good, then, render is going to pump. And if the quarterly earnings are bad, then, render is going to dump. And it actually leads me on to the second way that we can use to determine when a potential consolidation is coming is that it has to do with news events, right? It doesn't even have to be over, but news events. And what you're about to learn here about news events is going to absolutely open your mind to just new possibilities. Here's how news events work, right? You're going to have retail traders on both sides. Basically every eyeball in the market is going to be looking at that news event and they're going to be making predictions. The market makers know this. The market makers know that people are going to be impatient and they're going to start taking bets. This is important to know because if these market makers know that everyone's going to start placing bets, they can just program the algorithm to deliver price in a consolidation. And this is going to allow all of these impatient retail traders that haven't yet identified, a clear trend, and then they're just going to be hopping into the chart and, again, placing bets. At which point, the moment the news event gets released or the results get released, the market will almost always do this type of what I like to call a pump and dump or a dump and pump to stop out both sides of the consolidation before the market continues on in its true direction. So as you can see, prior to the news event, right, a few days prior, the market makers put the market into some kind of consolidation. The moment the news event happens, boom, you stop out everyone that has your stop loss here. You trick traders into thinking that there's a breakout because the news event was actually good. And so all these, quote unquote breakout traders, they're going to be buying high just to get stopped out. And then immediately you make a really fast and aggressive move to stop out all the traders that have their stop losses placed underneath you. And so both sides of the equation are losers unless you knew that this was coming. You could see the consolidation. You could see how price was setting up for this move. And you were able to take advantage of the sweep of the range high to target the range low where the opposite side of the liquidity is sitting. And this is the gist of the framework that I'm going to teach you in this video on how to not only identify consolidating markets, but to actually profit from them. That's one way. Now, news events are one of the ways to identify a potential consolidation that's on the way. And in fact, just to give you a little bit of proof, I actually talked about this on Twitter prior to the NVIDIA news event. So I basically saw this coming. And this framework that I just taught you about is exactly what I used to determine this liquidity sweep. Now, obviously, I was looking at this on a way higher timescale. And like, sure, I might not have gotten the exact level right, but the mechanism for which I was using to determine this was correct. And essentially, all you can see here is you have a range low, you have a range high. In this case, I was actually looking at the range high here, which is just to show you a range high that was a little bit higher. So this is the range that I'm talking about. Essentially, the mechanism works the same. You just need to apply this principle to different timeframes, which, by the way, this does work on every single timeframe. The markets are fractal, and every single concept that works on the daily chart will work on a 1 minute chart, and vice versa. And by the way, if you're watching this video right now and you want to follow me on Twitter, it's very likely that I will have changed my username because I'm recording this video prior to the big decision to actually, go personal brand and show my face on the internet. If you do want to follow me on Twitter, I will leave a link in the description box below. And if you'd like a peek into more, lifestyle content or just personal content, then you can follow me on Instagram, which I will also leave a link down in the description box below. But otherwise, so essentially, news events are one of the ways that you can use to identify when a potential consolidating market is coming. And I've given you the framework on how to trade news events to profit, immensely from the news event. The only thing that I haven't really added onto how news events work is that you never want to trust the news. Every bit of information that you could possibly need from how a news event is going to play out is actually on the chart, right? The longer you spend looking at charts and the more you understand about trading, the more you realize that all of the news events in the history of the world are all priced in. Sure, the news might be quote unquote bullish, but that's definitely not what the chart was telling us. And again, after watching this video, I have a feeling that you're going to really understand how to trade news events in the future. Anyways, so that was one way to, determine if a consolidating market is coming. The second way is to look at higher time frame key levels. When a higher time frame key level gets taken out, then the market goes essentially from a phase of high volatility into low volatility, right? That's how the market works. So just to give you an example, let's use this swing low over here, right? Let me just remove this level. Let me remove this circle here, and let's use this key level. And this is a swing low. And the reason why we're using the candle bodies, by the way, and not the candle wicks is because most of the institutional volume is concentrated in the candle bodies. And I want to paint another picture for you just so you understand this. Let's say that this is an example of a daily chart that we're looking at. So this is going to be the candle on the daily time frame. So that's a lower wick. So this is on the daily chart, and this would be your 1 hourly time frame. If you zoom in on how this candle looks like, you can see that most of the volume tends to be concentrated around this area, but the wicks are really easy to manipulate. This is what I mean when I say most of the institutional volume, meaning when the smart money and when the market makers are looking at the market and determining which, levels are the liquidity levels, they're looking more so at the bodies rather than the wicks, just because of how easy it is to manipulate the wicks. This is why I'm using the candle bodies, and candle body gets taken out right here. And then immediately the market goes into a little bit of a consolidation. And I know it doesn't look that way on the chart, but this is indeed a consolidation because you have a very clearly defined range high and you have a very clearly defined range low that the price was bouncing between. And just to illustrate this further, this is how that consolidating market looks like, where you have a range high, you have a range low, and price was in a consolidation. Now, of course, every time frame that you look at, these consolidations are going to look different. For example, this looks like a fairly aggressive move, but within the big picture, you are within a consolidating market, which is why I mentioned earlier that, price is always in some kind of range. And as long as you can identify what the range is, then you can take advantage of the framework that I've been teaching you to, profit a lot from ranges. So notice how the move to get to, the key level is actually pretty aggressive. But after that, the move gets a lot smaller, right? And at this point, you might be wondering, like what is a higher time frame key level? And all I want you to imagine higher time frame key levels being is, think of them as like long-term targets that the market makers are programming the algorithms to when they're delivering price. Like at every given point in the markets, price is always reaching for some kind of target. And most oftentimes, this target tends to be some kind of key liquidity point on a higher timescale. And 99% of the time, this higher timeframe target tends to be some kind of liquidity point or some kind of key liquidity point on a higher timeframe. So now just to explain this concept better, I'm going to use this Bitcoin chart. So let's go all the way back to, let's say, the 2021 bull market. Let's look at this range over here, which price spent quite a lot of time in. So when price was at this point, you could say that the higher timeframe target, right, the higher timeframe key level is going to be here, right, because it's the opposite side of the range. This is the range low, this is the range high. And I can't find the tweet right now, but I was one of the very few people that actually predicted that this would be the bottom because, you know, I use the exact same framework. Can't find the tweet right now just because it's been quite a long time, but you just got to take my word on it. This was the exact framework that I used. And once the range low has been taken out, you immediately start putting your eyes onto what is the next higher time frame target, and it's going to be the range high. And until that target gets taken out, price tends to remain pretty volatile. The moment that target gets taken out, I want you to just draw your eyes to the consolidations that happened around these levels, you know, once the target did get taken out. Now, of course, once you were at this point here, it would have been quite impossible to predict that, you know, oh, you know, you're in a bear market now and where's the target? I want you to notice where the consolidations tended to happen. So you're getting a consolidation over here prior to a high volatility move, where you've taken out this swing low right here, right? This was a very key swing low. The moment that gets taken out, right, the market goes from high volatility to low volatility, right? Same thing here. You can see that there are, you know, a couple of key levels over here on the daily chart. The moment that gets taken out, boom, market enters into a little bit of a consolidation where you build up liquidity here, sweep the liquidity before driving the markets lower. But the key here is that this was some kind of a key level, and price prior to hitting those key levels was very aggressive. In fact, this was one of those key levels right here that almost got taken out. If we head over to some other charts, that level would have been taken out. And as you can see right there, it did actually get taken out on perpetual futures. So notice how price was super volatile prior to taking out that level, but the moment that level gets taken out, boom, you enter into consolidation. This is exactly what I mean by, like, one of the ways that you can identify if price is about to go into some kind of consolidation is using higher time frame key levels. Once that gets taken out, followed by a very volatile move, then you know the market is about to go into a range. How is this relevant to you? Well, now that you know that after every, you know, high volatility move that leads to a key level getting taken out, you never have to ever worry about FOMOing into coins or trying to catch the bottom. Now, you don't have to worry about catching falling knives anymore because, you know, like the moment the level gets taken out, you're still going to get, you know, you're going to get a range high, you're going to get a range low, and very likely, and I'm talking 99% of the time, prior to price actually pumping, you will take out the range low of the range that forms after that volatile move that takes out the key level. I know that is quite the mouthful, but look at this, right? Price takes out the key level, goes into a consolidation to where this is your range high and this is your range low. Prior to this pump that leads the market higher, you actually take out the range low prior to this move, right? Let's go to Bitcoin, for example, and I can show you so many examples of Bitcoin. Recently, here you have a consolidation. You take out the range low, which is right here. This was the liquidity sweep prior to the up move. And let's start off before Bitcoin actually, you know, went out of the bear market and left the bottom. So everyone that tries to catch a bottom, let this be like a bonus lesson for watching this video. For every time, like every person that tries to catch a falling knife, there's like 10 other people that gets like absolutely destroyed. And the numbers are probably a lot more than 10 because for everybody that's been buying at any point here, trying to predict the bottom and to try to catch the bottom or whatever, like they would be in such deep losses that if they didn't hold until now, like this is 2 years later, as of the time that I'm recording this video, they would still be at a loss. But if you just wait for the bottom to form, and the way you do that is to wait for some kind of consolidating market to form, wait for the range low to get swept, and that is where you buy, and then boom, right? It's as easy as that. Even in the bear market, this was the bottom, that was the consolidation, and the moment the consolidation gets swept, boom, right? Again, once more, this was a higher time frame key level. So let's look at this level here and draw it further out. This was the higher time frame key level. Prior to this, price was actually making quite volatile moves. After that, you have a very clearly defined range high, which is there, clearly defined range low, which is there. You could also argue, you know, the range started from here. Price swept this level before pumping, right? You don't have to worry about catching bottoms in this case. So once more, price forms a really long consolidation over here and over here, right? This consolidation lasted for months, 4 months to be exact. And the moment that range low gets swept right there, boom, price starts its move. So once you understand this concept, you never have to worry about catching falling knives again, because like in every dip, you will see some kind of consolidation. And the moment you see some kind of consolidation, you're very likely going to see that range low get swept prior to the move, or some kind of retracement to the 0.705 or the 0.618, in which case Bitcoin did over here. So that was quite a mouthful, but those are the two ways that you can use to determine consolidations. Now I'm actually going to teach you the framework on how to trade these consolidations. And throughout this video, I think you would already have gotten quite a good idea on how to do this. But just to give you a little bit more detail into how this framework actually works, all you're looking for is, again, some kind of consolidation to take place. You can identify this. All you want to do is, on whatever time frame that you're using, you want to wait for either the range high or the range low to get swept. Swept meaning get taken out, right? Price trading above the range high or price trading below the range low. You want to ensure that when you're looking at these liquidity points and when you're looking at these range high, range lows, you want to use the candle bodies and not the candle wick. And once that level gets taken out, all you want to look for is some kind of displacement before your entry. And just to explain to you what is a displacement, let's take a look at the 1 hourly chart. Notice how the moment the price trades above this level here, very next candle engulfs that near previous move. And this is another way that you can describe displacement, which is some kind of engulf, meaning a very strong aggressive candle that, shows you that the market makers are in the game. Because let's face it, us retail traders are quite literally fish in the ocean, as you can see. No matter how many of us retail traders band together to try to, move the markets, chances are, we're not going to do anything. Chances are we're not going to move the markets by any meaningful amount. That's because of how little money we have. But the market makers, on the other hand, have access to literally billions of dollars to move the markets. They are the only ones that can move the market in a very meaningful way, meaning those straight up, straight down moves, they're all done by the market makers. So when we are looking at ranges and we're trying to trade these liquidity sweeps, we want to see a sign that the market makers are involved in this trade in the same direction that we're looking at, meaning once range high gets swept, we're looking for a short, right? To target the range low. We want to see some kind of sign that, there is quite an aggressive movement towards the downside to confirm that the market makers are in. And once we see that, we can enter quite literally at any point of the displacement and just place our stop loss above or below. Like if we were to take a long, for example, here, the liquidity does get swept, boom. And so in this case, we would go at any point during the displacement and place a stop loss underneath the wick of the liquidity sweep and target the opposite side of the spectrum. So in this case, the opposite side of the spectrum would be right here. And of course, the stop loss on these is quite huge because I'm doing this on a 1 hourly chart. I usually do this on a 15-minute chart. So that's where I get an opportunity to really refine my entry, which is something that I'm going to be teaching you right now. Like at this point, you might be wondering hey, what time frame am I supposed to be using here? Well, the very simple rule for timeframes is you want to have a combo of an environmental timeframe and an executional timeframe. And the way you identify this is to use a factor of 4 to 6, meaning if you plan to execute or if you plan to take trades on, let's say, the 15-minute chart, you just want to multiply that number by 4 to 6 and find a higher time frame that fits within this criteria. So in this case, 15 minutes times 4 is 60. 60 is 1 hour. So if I'm trading on a 15-minute chart, the 1 hourly time frame is going to be my higher time frame, and 1 hourly time frame is going to be the time frame that I'm using to determine these key levels to where I'm looking for that liquidity sweep. Now, the 1 hourly time frame, or now the higher time frame, is also what you use to determine any big picture consolidations that you could potentially take advantage of. And mind you, the environmental time frame is it's only used for that, which is determining the environment. When you're actually executing, you want to go onto your lower time frame to execute, because this allows you to get a much tighter entry without losing sight of the big picture. The mistake that most people make is that they only look at one time frame, and so either they completely lose sight of the big picture, or they're so big picture that they fail to refine their entry, and that's why they end up with trades with only 1.5 R, even though this is quite a large movement in terms of percentage dump. Similarly, if I were to take a trade like this, even though it's like a 13-15% pump, I only get 3R, right? This is the drawback of only executing from a very high time frame. And if you only execute from a very low time frame, you're going to lose sight of the big picture. You will not even realize that price is, in this kind of a range, and you're just going to be blindly trading all these little moves here, and you're going to get stopped out a lot. You're going to have a really low win rate, and you're going to lose a lot of money. And in general, you're just going to have quite a miserable time trading. And the simple fix to overcome that is to have two timeframes, right? An environmental time frame, execution position the time frame, separate both by a factor of 4 to 6, and boom, you're done. So just to give you an example of how this looks like, if I were to be doing this, in real time, I would look for key level to get swept, would mark out the key level on the 1 hourly time frame, and then once that level gets taken out, I will look for some kind of engulfment on the 15-minute chart, in which case I do get it on this candle here, when there's quite an aggressive movement. And the moment that happens, this becomes a fair value gap right here, which the next candle trades above. And you don't even have to worry about fair value gaps and order blocks and whatever. The moment you see displacement happen, you can enter literally at any point of the displacement. So now, instead of my entry being all the way down here, if I was trading on a 4-hourly chart or 1 hourly chart or something, let's say I enter in quite a bad spot. I enter here, right? I don't get in right when the displacement happens. I get in here, right at the bottom. And even then, instead of having like a 1.6 R trade, now I'm looking at close to 3.2, right? Just by going onto a lower time frame, I pretty much double my potential profit if the profit target were to hit. Now, obviously, you can do a lot better than this, but even just this works perfectly fine for any level of trader, even for myself. But this, just entering at any point on the displacement, works perfectly fine for any level of trader. And again, the stop loss you want to place above the wick of the liquidity sweep. Whatever wick that forms after the liquidity sweep is where you want to place your stop loss. Now, you might have realized that there were actually 2 liquidity sweeps right here. So what if you entered on the first one and then you get stopped out? What do you do on the second one? Now, the rule on this is very simple. If you get stopped out the first time, you simply enter again on the second time, as long as the criteria still fits the bill. Like, if this is a trade that no longer is valid and following this framework or following the system, then you don't take it. And this is a very good way to think about trading in general. How do you determine if you should continue to buy into or to take this trade again? Well, is it valid? Does it fit your system? If everything still checks out, all the criteria still matching, then yeah, go in. It's a good trade, at least following your system. So in this case, on the second trade, a very good practice is to go half risk, meaning if you went in with 1% account risk on the first trade, on the second trade, you're going to go in with 0.5% account risk. And you do this to prevent yourself from getting into what I like to call the death spiral of trading, where you lose a trade, you get really pissed off, you sort of want to get back at the market. And so you get in again on the second trade, usually not following your criteria and not following your system. You're just getting in because you're emotional. And on the second trade, you are increasing the risk that you take on. So the first time you entered with $1,000, the second time you're going to enter with 2,000, and you're going to lose that second trade because again, you're taking an emotional trade. You lose the second one, boom, your account just goes down by quite a lot. And that gets you even more pissed off. And the cycle repeats until you lose all your money. And this basically prevents it from happening, because if you lose the first trade, if you're, closer to being a beginner, then you're probably going to be a little bit emotional. And going half risk just prevents you from going into the death spiral of trading. And for the take profit, it's also very simple. Like, just go onto your higher time frame and take profit on the opposite side of the range. Meaning, if you take a trade at range highs, you're going to close out the trade at range lows. And if you take a trade at range lows, you're going to close out the trade at range highs. Let me just give you one other example of how this long would look like. So as you can see, price actually sweeps this level initially over here and then once more over here. So this is how it would look like if I was executing in real time. So once this level gets taken out, I'm going to look for some kind of displacement. So in this case, it would, it could be this candle. It could also be this candle. Both are valid. So let's say I'm taking it on that candle right there. I'm getting in at any point during displacement. I'm going to place my stop loss underneath the swing low. And then I'm going to target, go back onto the 1 hourly chart and mark out the swing high. And the swing high is right here. So this immediately, just by having 2 time frames, I go from a 3.2 up to a 4.08. But that's only the first trade. And honestly, that's not the best trade that you can take with the system. Second trade happens when you would have gotten stopped out on this one. And once you did, as long as the criteria still checks out, you can enter again on the second trade. Once liquidity sweep happens, you see displacement, boom, stop loss there. And now you went from a 3.2 up to a 4.3. Again, these are not the best examples. I'm just showing you how this framework works. And your TP would be at the same level, which is go onto the 1 hourly time frame and boom, right? As simple as that. And this is essentially how you not only identify consolidating markets, but also just profit huge out of these consolidating markets. And just remember, like, the market is at any given point, the market's always in some kind of range. And if you learn how to trade ranges, man, this is such a powerful technique, because this is quite brain dead. You don't have to think about, where the market's going to go. As long as you see some kind of range, short the range high, take profit at range low, go long on the range low and take profit at a range high. It's as simple as that. Very high probability and quite a lot of profit, because this tends to be quite asymmetric in risk to reward, meaning when you take a trade on range low, your stop loss is quite small. your potential gain is quite big. Similarly, if you're shorting the range high, very small stop loss, but very big potential gain. This is the beauty of trading ranges. Now again, all of this applies on every single time frame. If this works on the higher time frame, it will work on the lower time frame. And by the way, if you believe that trading can give you the freedom that you deserve, but cannot for the life of you figure out how to make this work, then feel free to click the first link in the description box below. Don't worry, it's not some $997 course. It's just a website showing you how my company is able to help you solve the problem. And no pressure. I don't really mind if you click it or not, but for those that this is relevant to and you would like some help fast tracking the learning curve, then, link is there whenever you feel ready to. But anyways, if you enjoyed this video and you found value from it, drop a like. It does really make my day. And if you want to see more content like this, then subscribe for more. And if you would like to see me make a video on a topic that you'd like covered, then drop it down in the comments below. But otherwise, thank you so much for spending your time with me. I truly appreciate it. And I'm wishing you a great day ahead. Cheers.